Energy stocks are exploding right now. But here's the uncomfortable truth. No one is telling you most investors piling into this space are chasing the wrong opportunities at exactly the wrong time. Because behind all the headlines about oil, gas, and AI, there's a much bigger story quietly unfolding. A hidden crisis that could decide which stocks double over the next few years and which ones completely fall apart. And it's not what you think. In fact, while everyone is distracted by geopolitical tensions and short-term price spikes, the smartest money in the world is focusing on something far more important, something that could reshape the entire energy market. Today, I'm going to break down 3 under-the-radar stocks that insiders are watching closely as this trend accelerates, and more importantly, 2 extremely popular names that investors are rushing into right now that could actually be major traps. And trust me, one of them might surprise you because it's been one of the hottest plays in the market. Now here's where things get really interesting. Right now, some of the biggest players in energy, technology, and finance are all having the same conversation. And it's not about oil shortages or even gas prices. It's about electricity. Because for the first time in decades, the world is facing a surge in power demand that the current infrastructure simply cannot handle. For years, electricity usage was relatively stable, barely growing even as the economy expanded. But suddenly, everything changed. The rise of artificial intelligence, massive data centers, and a wave of reindustrialization has created an explosion in demand that's catching everyone off guard. And here's the scary part. This isn't a temporary spike. This is the beginning of a multi-year build-out that could last 5, even 10 years. Companies are already scrambling to secure power, striking deals behind the scenes, and preparing for a future where electricity becomes one of the most valuable resources in the economy. So the real opportunity isn't just in energy stocks as a whole, it's in identifying the exact companies positioned at the center of this shift. Because while some businesses will thrive as this demand skyrockets, others, despite all the hype, won't be able to deliver. And by the end of this video, you'll understand exactly where this trend is heading, why it's happening right now, and how to spot the winners before the rest of the market fully catches on. Right now, everyone is talking about energy stocks going up, but almost no one is asking why this is really happening. Most people assume it's because of oil prices or global tensions. But that's only a small part of the story. The real driver is something much bigger and much more urgent. Electricity demand is exploding. For over a decade, power usage barely moved. It was stable, predictable, almost boring. But in just the last few years, that completely changed. Suddenly, demand started rising fast. And now it's accelerating. The reason? Artificial intelligence, data centers, and a massive shift toward digital infrastructure. Every AI query, every cloud service, every data center requires an enormous amount of power. And here's the problem. Our current grid wasn't built for this kind of demand. Not even close. Behind the scenes, the biggest tech companies in the world are scrambling to lock in power deals because they know what's coming. And this creates a massive imbalance. Rising demand, but limited supply. That gap is where the biggest investment opportunities are forming right now. But here's the twist knot. Every energy company benefits equally from this trend. Some will dominate, while others get left behind. The first opportunity most investors completely overlook is not flashy at all. It's not a trendy AI company, and it's not a big-name energy giant. In fact, it operates mostly behind the scenes. But without it, none of this growth would even be possible. This company is essentially the backbone of the entire build-out. It helps construct power plants, expand the electrical grid, and even supports the infrastructure behind data centers. Think about that for a second. If billions are being poured into building the future of AI and energy, someone has to physically build it. And that's exactly where this company comes in. What makes this even more interesting is the massive backlog of projects they already have lined up. That backlog represents future revenue that's almost locked in. But the market still isn't fully pricing in how big this wave could become. And here's where things get really counterintuitive. Normally, investors avoid stocks that have already gone up a lot. But in powerful growth cycles like this, the opposite can be true. Stocks that are already rising often continue rising because the underlying demand keeps increasing, which means this could be just the beginning. Now the second company is a completely different story, but just as important. This business used to be considered boring. It focused on small industrial components, the kind of things most investors would ignore. But over the past few years, it has quietly transformed into something much bigger. Today, It plays a critical role in managing how power is actually used inside data centers. And this is something most people don't think about. It's not enough to just generate electricity. You also need to control it, regulate it, and make sure it's delivered safely to extremely sensitive equipment. One mistake and millions of dollars worth of hardware could be damaged instantly. That's where this company comes in. It's creating solutions that make power usable for the AI economy. And one of its newest innovations is already generating massive demand, despite barely existing before. This kind of shift from a legacy business into a high-demand growth player is exactly what creates big opportunities. But because the transformation is still ongoing, the market hasn't fully caught up yet. And that disconnect between perception and reality is where smart investors start paying attention. Now here's where things get even more interesting, because for all the talk about renewable energy and futuristic solutions, the reality is much simpler. For the next several years, AI will run on one primary source of energy, and that's natural gas. It may not sound exciting, but it's absolutely critical. The reason comes down to reliability. Data centers need power 24/7 without interruption. Solar and wind can't guarantee that. Batteries help, but only for a limited time. Natural gas, on the other hand, can provide consistent, stable energy whenever it's needed. And as demand for AI infrastructure grows, so does the need for this kind of reliable power. That puts certain companies in a very strong position, especially those that already have the resources and infrastructure in place. What makes this even more compelling is the combination of short-term demand and long-term necessity. While other energy sources may take years to scale, natural gas is ready right now. And that makes it the bridge powering this entire transition. But of course, with opportunity comes volatility, and that's where many investors get shaken out too early. Now, let's shift gears. Because not every company tied to this boom is a good investment. In fact, some of the most hyped names might be the riskiest. The first one falls into what I call the overhyped trap. On the surface, it looks like the perfect way to play the AI boom. It's directly involved in building out infrastructure. It's getting a lot of attention, and investors are pouring money into it. But when you look deeper, the story starts to fall apart. The business model itself isn't nearly as strong as people think. In reality, it operates more like a low-margin service provider than a high-growth innovator. And that creates a big problem, because while the hype suggests massive profitability in the future, the actual economics don't support that kind of growth. In fact, the expectations built into the stock price are extremely high, far higher than what the company has historically delivered. This creates a dangerous situation where even good performance might not be enough. And when expectations are too high, disappointment becomes almost inevitable. The second stock to avoid is even more interesting because it represents something that could be the future. Just not yet. This is where a lot of investors get caught. They see a powerful long-term trend and assume the companies leading it today will automatically win. But timing matters, and in this case, the technology is still years away from becoming mainstream. The company is working on advanced energy solutions that sound incredibly promising, but there are still major hurdles, technical challenges, regulatory barriers, and high costs. Meanwhile, the market is already pricing in massive success, as if everything will go perfectly. That's a risky assumption, because when expectations are based on what might happen far in the future, even small delays can have a huge impact on the stock. And right now, there are other companies that are further ahead with more proven track records, which means the risk-reward balance here isn't as attractive as it seems. Sometimes the best move isn't chasing the future, it's focusing on what's working right now. When you step back and look at everything, a clear pattern starts to emerge. This isn't just about energy stocks going up. It's about a fundamental shift in how the world consumes power. AI, data centers, and digital infrastructure are creating demand at a scale we haven't seen before, and the system is struggling to keep up. That's why this opportunity is so powerful, but also why it's so misunderstood. Because while many investors are chasing headlines, the real winners are the companies solving immediate problems, the builders, the enablers, and the providers of reliable energy, not the ones relying on hype or distant future promises. And this is where the biggest advantage comes from, understanding the difference. Because in every major investment cycle, there are clear winners and clear losers. The challenge is identifying them early. And right now, we're still in the early 2 stages of this trend, which means the biggest moves may still be ahead. The question is, Are you positioned in the right places before the rest of the market catches on? So here's the bottom line. This isn't just another short-term rally in energy stocks. This is a massive shift happening right in front of us. The world is entering a phase where electricity, not oil, not hype, is becoming the most valuable resource, driving the next wave of growth. And when that kind of shift happens, fortunes are made in very specific places. The companies building the infrastructure, controlling the power, and supplying the fuel, they're the ones quietly positioning themselves to win. While on the other side, the most hyped names, the ones everyone is chasing, are often the ones with the biggest risk hiding underneath. And this is where most investors get it wrong. They follow noise instead of understanding the real trend. They chase what's already popular instead of what's actually necessary. But the biggest opportunities always come from seeing what others are missing. Right now, we are still early in this cycle. The demand is just getting started. The build-out is far from complete, and the market hasn't fully priced in what's coming next. So the real question is, when this trend fully plays out over the next few years, will you be positioned in the companies driving it, or the ones getting left behind? If you found this breakdown valuable, drop a comment and let me know which stock you're watching. And make sure to subscribe, because the next big opportunity is already forming and you don't want to miss it.